Hello traders, this is Frank Paul from Forex Mentor speaking with you on Wednesday, June 13th, 2012. Welcome to this second weekly free video that we've posted since we launched the new FX Systems Lab monthly service June 1st. And the idea behind these weekly free videos is just to give you an idea about the latest trading system that we've posted, and maybe this will spur some thinking for your own personal trading plan. What it's all about, just to give you a quick sales pitch, is we have 12 richly detailed and presented trading systems to be posted over the next 12 months. We have the first, the MACD 3-screen histogram trade for June, and we'll be following that up with 11 more trading systems. Each will feature their own foundation course together with 3 times weekly narrated video reviews of recent trade setups featuring this particular trading system. And by the way, if you're wondering, do we only show winning setups? No, we'll show you some non-winning ones as well, including today's sample video. And each of these also is backed up with what we call a cheat sheet, which is a multi-page long flash PDF which documents in detail with chart illustrations the rules and guidelines for each trading system. We'll also be running a members request contest in April of next year as we count down the final weeks of this initial rotation, selecting a winner who will receive a cash prize of $500 US. Not half bad. If you've got a trading system that you're particularly proud of and would like to share with others, here's a way to make a little bit of money at it. That and some other features coming your way over the next 12 months. By the way, you don't have to be a 12-month member to avail yourself of any of the systems. We have a complete table of contents available at our public homepage, and you can feel free to pick and choose from amongst those if you prefer. Just as a reminder, if you saw last week's video, the 3-screen MACD histogram trade is a momentum-based trading system that is scalable to suit all of the main trading styles as desired. That means on the monthly chart on down for position trading, weekly chart on down for swing trading, daily chart on down for day trading, and 4-hour chart on down for scalping. Any of those trading styles can be pursued with our scalable approach. We do offer time frame specific trade entry and management rules to guide the process from start to finish as well, again as laid out in this month's foundation video. Here's just an ultra fast run through of the steps in the process. First, we begin by finding a MACD histogram 3-screen reading, that is 3 consecutive time frames, giving us histogram bars on the plus side or the minus side of the midline, and only 3 consecutive time frames lining up that way. We then seek to corroborate that particular momentum reading by finding evidence of market flow aligned in the same fashion on one of the 3 time frames in the triple screen. We then drill down to the next lower time frame to look for a fractal retracement pattern. Fractal just meaning smaller version of a larger continuation pattern. We monitor that fractal retracement through to completion, where we might label it swing point C for a corrective top or bottom. We then assess the anticipated reward to risk profile of the trade, confirm that the momentum reading on the higher time frames remains intact before we consider pulling the trigger. If it is not, we do not proceed. If it is, we'll enter the trade and put on stop and limit exit parameters. Again, assuming the reward to risk profile is sufficient. 1-to-1 on scalps, 2-to-1 or better on day trades, swing trades, and position trades. Then we monitor and manage the trade through to completion. In the case of a scalp, it's pretty simple. We just apply a 20 pip limit exit, and we don't rush to trail the stop too quickly because it's very easy to take yourself out too soon, really, when it's just a small increment of just 20 pips that you're shooting for. And then finally, when the trade has come to completion, whether for win, loss, or draw, we conduct a post hoc review and diarize the trade in an appropriate trading journal. So let's take a look at today's sample, we're going to look at the Euro-Kiwi pair. Now, I'll just forewarn you right now, we're not showing you a winning trade setup today. It's not a losing setup either. But what I want to do is give you a real-world feeling for some of the scenarios that you'll run into. One of them being where reward to risk is not sufficient. That mirrors the example we're offering up for our members in today's weekly trade illustration video in our members area, which looks at a different pair and a different setup. We're showing this to you to help you understand how you would apply it, and sometimes how, even with the right momentum readings and with what looks like a valid setup, you might have second thoughts before you pull the trigger, for good reason. So for the Euro-Kiwi pair, we were looking for a day trade short on Monday, June 11th, Monday of this week, and the momentum signal came by way of the daily 4-hour 60-minute charts lining up together, which means, of course, we drill down to the 15-minute chart as our execution time frame. The entry bar, potentially, in this case, was 2:45 p.m. GMT at a price of 1.6184. Now, obviously, Euro-Kiwi, if you're at all familiar with it, has a wider than typical dealing spread, at least on most dealing platforms. And so that would have to be factored into the equation as well. If it was just 2 or 3 pips, we wouldn't care so much. But if it's 12 or 15 pips, even with the lower pip cost of Kiwi quote pairs, we're still going to be a bit concerned if the profit potential is limited. So the initial protective stop here, using the technique we espouse in our foundation video, a so-called dynamic protective stop, would have been placed at 1.6246. That results in initial risk of 62 pips, not even factoring in the relatively high dealing spread of the Euro-Kiwi cross, which would have put it well over 70 pips for sure. And based on the method I'm going to show you, it was logical to expect price to come down to the daily S1 pivot at 1.6158. That pivot happened to overlie really closely a 5-day average daily range derived target. We'll show you how we came to that conclusion. So the target profit was only 26 pips, excluding spread. Might have been as low as 10 pips after spread. So if you're looking to grab maybe 10 pips, if there's reason to believe that price might not go any further than that in the favorable direction, would you risk 62 pips, call it 70 pips, including dealing spread, to make 26 pips profit? I would hope the answer is an unequivocal no every single time. So in this case, the reward to risk potential was insufficient, which means there was plenty of reason not to pull the trigger. Your primary impulse should be not to pull the trigger, only overriding that impulse if there's just such an unbelievably overwhelming confluence of factors justifying the attempt. So even though we won't see a winning trade setup here, hopefully you'll glean enough in terms of how we approach the trade setup, that combined with factors against a trade, how to keep yourself properly on the sidelines. Together, all that information I hope will be helpful for you. So let's now flip into chart mode and run through this thing start to finish. We're now looking at a 4-chart tiled display for the Euro-Kiwi pair. This would comprise all of the time frames appropriate for framing a day trade. Of course, you would also look at the weekly, monthly charts, and you might use the 5-minute chart, but these 4 time frames represent the core grouping of time frames for a day trade, comprising daily chart top left, 4-hour chart top right, 1-hour chart bottom left, and 15-minute chart bottom right. I have moved the right-hand side of the chart to as close to the entry point as possible on all 4 time frames, so we're trying to replicate as best we can here what the charts would have looked like in real time. I'm just going to add one more thing to the daily chart. I'm going to add the 5-day average daily range indicator, because we are going to use that particular metric for framing a day trade. So let's begin with the daily chart, and as of June 11th, we have got a red histogram reading on the latest close, which was obviously June 8th, Friday, June 8th. In fact, it goes all the way back to May 25th. One red histogram bar after another, after another, after another. Now, I might anticipate what could be a complaint or concern about the MACD histogram as a momentum indicator as compared to other things like, for example, parabolic SAR. It will lag, comparatively speaking. Parabolic SAR is much faster. If we plotted it, particularly using a fast setting, I'm sure you would have seen, for example, a counter-trend bullish parabolic through here, resolving to trend somewhere around here. Well, let's just test that theory out. Just going to do a bit of a digression here for a moment. Not with the default settings, but in our Fibonacci Swing Trader service, for example, we use fast settings on the higher time frames. And you can see we got, as anticipated here, a counter-trend bullish reading. So parabolic was faster and more responsive. So then the complaint is, well, why would you use the MACD histogram? Well, it all comes down to taste, because the thing this has got going for it is that where it lags, when it moves with multiple readings in a row, it tends to be more reliable. You don't have so-called noise signals here, which you will have with an indicator like parabolic SAR with fast settings. Those noise readings can come in very handy, but just the same, it's a more solid trend reading here. It started May 28th. Yeah, you could complain that it was a couple days off the high, but once it got going, it stayed that way. So the daily chart has been bearish since the open for May 28th. Okay, so a bit of a digression there, but I just wanted to point that out in case anybody's wondering, well, gee whiz, does this thing lag a little bit compared to some alternatives, and if so, why would we use it? Well, it lags, but wherever you get lag, you tend to get stronger readings in a trending market like this, so something to consider. So there's the first red histogram bar. On the latest close, Friday, June 8th, it was down. It was bearish, so the daily chart is bearish. So then we come to 12 p.m. GMT, June 11th, which is the closest timestamp on this chart to the potential entry point. And we can see the same thing here again. Yes, on the latest close, we had negative histogram bars as well, but in fact that goes back a ways to the close for 12 p.m. GMT, Friday the 8th. Okay, and we can even take that one step further and find evidence for bearish market flow. There's an impulse wave down to the swing point low for 12 p.m. on the 7th. There's a retracement to a lower high. Price breaks the interim low, heads lower. There's bearish market flow right there. That is a so-called reversal wave on the 4-hour chart. So we're more than 2/3 of the way to finding a valid bearish triple screen reading. And we drill down now to the hourly chart, and as of 2 p.m., 1400 hours GMT, Monday, June 11th, we can see again we've got a red histogram reading already in progress going back to the close for 10 a.m. GMT. And here too we've got evidence of bearish market flow. This time going back to 2 a.m. Friday the 8th. Impulse wave down, retracement to a lower high, breaks the low right on this bar here. So that's as far as we can take it in real time on the 3 higher time frames. I would suggest that constitutes bearish momentum. We're looking to sell a lower level rally. By lower level, I mean drilling down once again to the next lower time frame, the 15-minute chart, which in this case we might view as our execution time frame. So let's do that. We're right here now, and on the lower time frame we're looking for a counter trend momentum reading confirming a retracement. We see it here with the green histogram bars. The first one on the close for 1:45 p.m. The histogram bars on all 3 higher time frames, as we've already seen, bearish all the way through. So we're looking for a corrective bounce off of what? Well, in the case of a downtrend, off a swing point low. So there's the low, 11:45 a.m. Price retraces to a higher low, sorry, a lower high. Sometimes I get the words mixed up. But there's a rejection wick for 2 p.m. There's 1 lower high, 2 lower highs, so that is a swing point. Now we have to trace backwards from what we'll call swing point B right here. We're looking for where did this impulse wave ending at B get its starting point, and I would suggest that was right up to here. 6:45 a.m. GMT. So that's one complete impulse wave down. And we'll just go ahead and label the high swing point A. And we'll connect A to B with Fibonacci. We're looking for resistance here. And by the time we get an entry point, there's no second guessing here. This was very apparent in the live edge right here as of the open for 2:45 p.m. We definitely have a swing point high on a very clearly delineated resistance level, the 50% Fibonacci right here, the dashed black line. You can see price came up to that level and bounced off it. So yes, even on lower time frames like the 15-minute chart and 5-minute charts, Fibonacci math can occasionally have an eerily precise effect on price. So we're looking to get in short 2:45 p.m. That is a valid entry trigger because that comes in the aftermath of a short-lived retracement here, putting the 15-minute chart on the same side of the momentum reading seen on the higher time frames, resulting in a so-called quad screen. 4 consecutive time frames now lining up the same way. Bearish histogram bars all the way through. Okay, so great. We've done that much work, but it's still not a sure thing that we want to take this trade. The first thing we have to do is figure out where would our initial protective stop be. So relative to the entry point of 161.84, we go back to swing point C right here. The high is 162.41. We're going to look to put our stop 5 pips above that level, 162.46. Okay, that's a so-called dynamic protective stop. It's placed 5 pips on the other side of swing point C. So again, before we pull the trigger, not after, we have to do the math and figure out what's the size of the initial protective stop. In at 61.84, and let's just factor in the dealing spread because in this case it's relatively wide. Let's assume it's going to be at least 12 pips. So in at 61.72 net, let's pull out our calculator here. Okay, our initial protective stop, again right there, 162.46, minus a real entry price of, again, let's call it 1.6172. That's 74 pips, which for a day trade is much too much. You should never have to risk more than 30 to 40 pips on a day trade. And if the setup is suggesting you should, then it's a bad setup. That's as simple as we can put it. Okay, there's no reason. 74 pips is a tight spread, or sorry, a tight stop on a position trade, but never on a day trade. So I would suggest that initial stop risk is too much. Now let's fine-tune that by figuring out where we would be likely to get out if we could get in. And I'm going to do what I'm going to do here is I'm going to add in our daily pivots. And I'm just going to make sure they're showing for this particular day. Okay, so as we look at a potential entry point here at 2:45 p.m., we can see the daily S1 is just below. Now, we also need to go back to our daily chart here and read off the 5-day ADR figure. So for Monday, June 11th, it's 148.6. Let's call that 148 pips. And I'm getting that by just hovering my cursor here on the daily bar on the ADR indicator in question, which by the way is a custom indicator I've built for the Pro Realtime platform. And if you happen to use the Pro Realtime platform and you want the coding for it, I'd be more than happy to send it to you. Just email me via frank@forexmentor.com. So anyway, 148 pips. And what this tells us is that if the trend is down, and it's a viable downtrend and we expect it to continue for at least the current daily session, then wherever we might find a candidate high for the day, we should subtract from that 148 pips to give us one idea as to where price might bottom out for the day before it goes sideways or bounces up again in a retracement or what have you. So we're going to do that, and let's go back to the 15-minute chart and see if we can figure out where the high of the day might have been achieved. Certainly looking backwards from this vantage point, 2:45 p.m., going back in time, you can see there were highs in the background, so it's just a matter of finding the right one. Well, really, it seems as though the highest high of the day was recorded right on the start of the current midnight to midnight GMT session. So this bar right here, 100 hours at 1.6293, that represents the high for the day. It lies in the background. It's easily identifiable. So let's go 162.93 minus 148 pips. That tells us we should expect price to come down to 161.45. So let's just plot that in. And our method here for day trading, the day trading adaptation of this three-screen MACD histogram, is to look for the nearer of a confluence of the 5-day ADR base target and the nearer daily pivot. So we're looking at two levels here which lie pretty close to each other. There's the daily S1 pivot, and then there's our ADR base target just a few pips below. In fact, it's 13 pips below. But this 13 pip increment is not enough to take us to the next half pivot or whole pivot. So I think this represents a little bit of an overshoot. In other words, if we were trying to put a limit exit on this level, price might find support on the daily S1 pivot first, which means that this would be a bit risky. So if we were to get in at all, I would suggest we should put a limit exit right on the S1 pivot here at 161.59. So again, we're doing the math and we're saying that relative to the entry point, nominally 161.84, but net of dealing spread probably 1.6172, that is less than 20 pips, really. So it's even worse than we described it in our summary table. Risking 62 pips to make less than 20, that's just bad math, bad trading math all around, because we have no guarantee that price will go lower. We've already seen prices covered a substantial portion of its daily range here. So let's just see what happened. Price later came down and precisely hit that S1 pivot. What do you think happened thereafter? Did it continue going lower? Well, there's a swing point low, and in fact, if you're watching closely, there is positive divergence. Okay, higher lows on the MACD histogram versus lower lows on price. So we've got positive divergence on a swing point low on the daily pivot of S1, which is the level where we thought it could turn the corner and head up. And boy, did it ever head up. Okay, by more than enough to trigger a break-even stop. And let's just follow it through further. Anyway, it was a bad trade, and it was definitely worth not taking. Our clue that this was a bad setup was bad reward to risk potential. So even though I wasn't able to walk you through a winning trade setup, I hope you get the idea for how we would approach the market here looking for one. Not a bad setup, that is, of course, a good setup. We begin with a triple screen momentum reading, looking for MACD histogram bars lining up the same way on 3 consecutive time frames. We corroborate that with an assessment of market flow. If it's there on one of the 3 triple screen time frames, we pursue it further. If not, we abandon it. If everything looks good to this point, we drill down to the lower time frame, in this case the 15-minute chart, looking for a fractal retracement, which we saw here, labeling A, B, and C, C ending right spot on a 50% Fibonacci. So this trade setup had that going for it as well. The only thing it didn't have going for it is that by the time we got an entry trigger here, enough of the 5-day ADR target had been fulfilled. There was limited potential and enough reason to be concerned as to whether price would continue far enough to justify an unusually wide stop risk. And it didn't. So that was anticipatable based on our projected low for the day. And again, I hope that even though it wasn't a winning trade setup, it gives you an idea how to approach the market in a systematic, methodical fashion. There's always some discretionary and thinking involved here, but our simple and reliable approach to reading momentum is about as objective as you can get, I think. And it was correct. Just the only problem here, a little late in the day. Price had already moved too far to make it viable as a day trade short. With that, I hope you found this useful and helpful. If you have any questions about this method, feel free to email me, frank@forexmentor.com. And please do check us out on our website, for the Systems Lab service, where you can find out more about the 3-screen MACD histogram method, as well as any of the other 11 trading systems that we'll be featuring right through to May 2013. The URL is www.forexmentor.com/systemslab. That's SYSTEMSLAB, Systems Lab, and that will take you to the appropriate homepage. Thanks for joining us today. Have a great rest of your week, and we'll be bringing another one of these free videos your way Wednesday of next week. Thanks again for joining us. Bye for now.